Now, under the Truth in Lending Act, we have what's called Medea. We talked about that a little bit earlier. Medea created the 373 rule. Once upon a time, way back in the day, if I were to do a mortgage loan, I could close that baby in one day. I could take the application, gather the documents, drive it to the lender. The lender could do a rush underwrite, finish it up, send it to docs. I drive the docs back to the borrower. Borrower signs those docs. I drive them back to the lender, and the lender funds the loan the next day. That once upon a time could happen. Today, those days are gone. That can no longer transpire because of Medea and the 373 rule. These are disclosure timeframes. You are limited to a period of days that you have to wait before you can close a loan. So the first three is you have 3 business days to send out your disclosures. So if you and I are you're the customer and I'm the loan officer, and I meet with you and we decide you're going to move forward with this loan. If it's a Monday, Tuesday, Wednesday, Thursday, by Thursday, I need to make sure that I have got your disclosures. Either I've driven them to you and I've put them in your hand, or I've dropped them in the mail by Thursday at midnight, okay? That is going to be your 3 days time frame to send out your initial disclosures. Now, under Medea, you have 7 business days that you must wait before you can close that loan. So now let's say, again, I met with you on Monday. On Thursday, I sent out your disclosures. Excuse me. On Thursday, you now must wait 7 business days before you can close. So if it's Thursday, you have Friday, Saturday, Monday, Tuesday, Wednesday, Thursday, Friday. You cannot sign those final loan documents until Friday of the following week because you have to wait 7 business days to close the loan. And then the last 3 of the 373 rule under Medea is you must, after signing, or if anything changes throughout the loan process, you have 3 days to redisclose. So let's say, for example, I thought your house was worth $100,000. Well, the appraisal comes back and the house is only worth $95,000. That changes your loan. Now, it doesn't make it dead in the water, but you may be required to redisclose because now your values and such have changed. If you're going to keep the same loan amount, but it's based on a lower value of your home, you're going to have a lower what's called loan to value. That's probably going to change your fees and your rate. If that is the case, then you, within 3 business days of learning of that changed appraised value or whatever item changed, you have to redisclose and make sure you get that information back to the borrower again. And then they have that 3 days to consider whether or not they want to move forward, okay? So 373, 3 days for your initial disclosures to go out, 7 days to wait until you can close, and 3 days for corrected disclosures. And with the corrected disclosures, the borrower must receive it a minimum of 3 days before the new closing. So again, let's say I signed my documents let me say I met with my client on Monday. I sent them their disclosures on Thursday. On Monday, I discovered that the appraised value is not what I thought it was. Now I have to redisclose within 3 days of learning of that new appraised value, and my borrower must receive them at least 3 days before I'm going to close because they need time to review that information. Okay? That is called the 373 rule. It falls under TILA, but it's because of the implementation of the Mortgage Disclosure Improvement Act. All right, we already talked about what business days are. Now, the Truth in Lending Act also has rules that regulate advertising. A lot of this is to prevent abusive practices in advertising, kind of the old bait and switch tactic. So when it comes to advertising, you have what's called a triggering term. A triggering term is anything in an advertisement that has a number. So that would be things like the amount of the down payment. 0 down payment, well, that's a trigger term. You'd have to also give the annual percentage rate. Amount of a payment, Payments as low as $500. That would be a triggering term, and you have to also give the APR in the advertisement. Number of payments. You're going to pay this over a 30-year period of time, or you're going to make 360 payments. That is a triggering term. You have to also disclose the annual percentage rate in the advertisement. Anything with a number, okay? So again, anything that you see here, anything about the rate or the terms or the down payment, anything that is in an advertisement that says a number, not like a phone number, but number as it relates to the terms of the loan, has to also be given the APR. Now here's an example for you. Triggering terms, 20% down, $700 a month, 1% finance. All of these items are triggering terms, and in the advertisement you also have to give the annual percentage rate. These here are not triggering terms, and you may be asking, well, that doesn't make any sense. 5% APR. Well, it's the one mandatory item, so there's nothing else to disclose because I've already given you the one thing that I needed to give you, which is the annual percentage rate. The only other thing that is allowed to the only other item that is not required to also give the APR is when you say 100% financing, which is the same as saying zero down payment. Nothing else zero, but zero down payment or 100% financing, because those two things mean the same, then that does not require additional disclosure of the APR. But anything else in an advertisement that includes a number must include the annual percentage rate. Now appraisals. Appraisals are a big part of the mortgage industry, especially when you're buying a home loan. The appraisal is regulated under the Truth in Lending Act, and it says you are absolutely prohibited from coercing, influencing, or encouraging an appraiser to misstate the value of a property. This used to happen all the time. When the first words out of an appraiser's mouth when the loan officer called and ordered the appraisal is, how much do you need? That's not my job to tell you what I need. That's your job to tell me what the property is worth. So if somebody at the Truth in Lending Act or the CFPB in this case is given notice that artificial inflation or improper coercion has occurred, then you may be at risk, number one, of violating the Truth in Lending Act, but you're also at risk of losing your license, having a ding on your license, having your license suspended, again, if you're an appraiser, because improper coercion occurred. Also, that appraisal typically cannot be used at all if the lender finds out that any improper coercion or influencing or bribing basically an appraiser to bring in a value at a higher amount. Now, please keep in mind, let's say I do bribe an appraiser to bring in the value at $500,000 or whatever I need the number to be, but the appraiser takes my money because, hey, he was short that month or whatever and wanted to make sure he had in a little extra cash in his pocket. He took the money, but he did not inappropriately state the value of a property. Then you've got a TILA violation because you did influence or improperly coerce an appraiser, and the appraiser took the money, which they shouldn't have done to begin with. But if they don't misstate the value of a property or they don't artificially inflate the value, then the lender can still use the appraisal. So you did something wrong, which is a TILA violation, but the lender can still use the appraisal as long as the value on the appraisal is accurate and is not inflated in any way. All right. So one of the things that falls into coercion or, again, influencing is saying that future appraisal work will not be sent their way if they don't do what you want them to do, telling that they won't be considered for any future jobs or positions or opportunities, telling an appraiser that they need to have a specific value in order to get your loan to go through, failing to compensate an appraiser because they didn't bring in the value at what you wanted them to, all right? And conditioning an appraiser's compensation on loan closing. The appraiser should get their money when they do the appraisal, not when your loan closes. All right. Now, an appraisal on closed end. Closed end loans are ones that have a definitive end date. Okay, if you do a 30-year fixed rate loan, your loan's going to pay off on that 360th month. Okay, that's a closed-end transaction. An open-end transaction is more like an equity line. It works kind of like a credit card. Charge it up, pay it back, charge it up, pay it back, over and over and over this cycle goes. All right, so there's no real definitive end date because you're going to probably pay it up and pay it off many times throughout the course of that loan, or the course of that equity line. So these rules apply to closed-end credit when there's a definitive end date to that loan. All right, and again, you can't close it if any improper coercion had occurred. If the coercion occurred, but the value was correctly stated, then you violated TILA, but you can still use the appraisal. Now, you can ask an appraiser for additional information, make additional comments, correct any errors. But let me tell you, sometimes appraisers, although we need them desperately for this line of work, they can be a little bit grumpy or hard to deal with sometimes, or hard to get them to explain things or correct errors. If that happens, please go online, look up the state regulatory authority for licensed real estate appraisers, and make a complaint, because your job is harder in the event the appraiser isn't doing their job. So if you know of somebody that is doing, influenced appraisals, inflating values, not doing their job appropriately, then make sure you report them to the proper state authority. Right? You can obtain many appraisals on the same property and choose whichever one is best for you. The borrower might have a problem with that because they're usually the ones paying for it. So make sure that you don't just spend their money arbitrarily. But sometimes if you get a low valued appraisal, you can bring in another one to see if that low valued appraisal really was that low, or was there a better appraisal that could have been done. All right, and again, you can withhold compensation if the appraiser is breach of their contract or if they're doing very poor quality work. So again, if somebody just has a really bad appraisal where there's incorrect information and they weren't thorough and they missed a lot of pieces and a lot of the information was wrong, or just typos, things like that. Not silly typos that don't really matter, but just old property information and it wasn't on this specific property, bad pictures, substandard work in general, then you can withhold the payment to them for the appraisal. But you usually have to go through what's called an AMC, an appraisal management company, which is where the appraisals are ordered through. But again, compensation can be withheld for substandard work. All right, servicing, what does that mean, right? Servicing is when you've got a loan that is already closed. Loan officers will hardly ever do this. I don't know, unless you're working in the servicing industry for mortgage loans, you probably will never have to do this, but you do need to know it for your exam. Servicing is when the lender is taking and processing the payments and maintaining contact with the customer after the loan is closed. So they distribute out the taxes and the insurance, they take in the payments, they process, they manage their escrow account. That is what a servicer does. Well, servicers are, held to a certain standard as well, and they have to adhere to the Truth in Lending Act. Number one, as a servicer, they are the ones that are receiving the scheduled periodic payments from the customer and processing those payments through, sending out the allocated funds to wherever they're supposed to be sent out to. It would be a violation to not credit the payment as of the day the payment was received. Also, a lender or a servicer cannot do what's called pyramid. Pyramiding is when you're charging fees for something that wasn't like an initial late payment. So let's say my payment's $500. And 1 month, I made my payment on the 7th, not by the 5th that was in my contract. So they received the payment on the 7th and they charged me a $50 late fee. I don't open my mail, I do all this stuff online. So a letter came in the mail and told me that I was 2 days late and I was assessed a $50 late fee. The bank cannot charge me $500 plus my $50 plus another $50 for not making the $50 late fee. Does that make sense? So I've got my payment of $500. I missed it. I was assessed a $50 late fee. The next month, because I don't open my mail, I gave another $500 for my payment. I never saw the $50 late fee. So then the next month I make another $50 or $500 and they charge me again $50 late fee for not paying the original late fee. They can't do that. They can only assess the late fee on the actual payment, the principal and interest payment, or the PITI, the taxes and insurance payment, that was not received in the first place. So they can't build on or pyramid and stack on additional fees for things later down the road. They can only stack on fees for actual late payments or, again, whatever else is written into your note and deed of trust or mortgage document. All right? They have to provide statements that show a payoff amount. Failing to do so would be a violation of the Truth in Lending Act. All right, that is all the highlighted nuts and bolts details of the Truth in Lending Act. Remember, go back to your 20-hour study materials from when you took your pre-licensing education and really read up and learn and know everything there is to know about the Truth in Lending Act. So now let's move on to RESPA. So moving on with RESPA, again, this is the Real Estate Settlement Procedures Act. This law was created in 1974, and it too has undergone a lot of changes over the years. There's been a lot of differences in the mortgage industry since 1974. So this law, again, is currently under the CFPB, the Consumer Financial Protection Bureau, because pretty much anything financially related in a transaction is going to fall under the CFPB. It used to be monitored under HUD, the Department of Housing and Urban Development, but again, since the 2008 and the implementation under Dodd-Frank of the SAFE Act, basically everything now falls under the CFPB. This too is also known as Regulation X. How are you going to remember this? Because you want to respect your borrower. Now, some people have said a better way for them to remember it is you take an X-ray of your respiratory system, and so that's X for RESPA. So if that one helps you, you can use that as well. All right, the whole purpose of RESPA is to help borrowers shop for consumer costs so they know and understand the services that are required to get a loan and how much those services are going to cost them. A lot of disclosure information. Now, covered transactions. Remember again, all mortgage loans fall under TILA and RESPA law. But the disclosures you give depend on the transaction. So you're either going to give TILA and RESPA disclosures or the TRID disclosures, which is the combined form, again, TILA, RESPA, integrated disclosures. So right now we're just going to talk about the RESPA items that are the disclosures. All right, so again, your typical types of loans, conventional, FHA, VA, all your standard loan types. Now, Section 8 of RESPA, backing up one second, RESPA has 3 primary sections. It's a lot about disclosures, but it's also a lot about these 3 specific sections. Now, Section 8 of RESPA, I'm going to ask you all a question. Have you ever heard of like government program called Section 8? Well, it's where the government helps people on low incomes pay for rent or to have a good, safe place to live, right? Well, I always think of that as like a government kickback. Section 8 housing, right? Well, Section 8 of RESPA is not the same thing as government Section 8, but what it is prohibits kickbacks or referral fees in exchange for sending somebody else business. So remember, Section 8, like the government housing kickback, well, this law is prohibiting kickbacks, okay? And basically, giving or accepting of a fee, a kickback, or anything of value in exchange for the referral of business, absolutely prohibited. I'm not kidding. If a real estate agent sent me business, I cannot give that real estate agent a stick of gum if it is in exchange for a referral. Now, I know you're thinking, well, real estate agents do this all the time. Real estate law and finance law, 2 totally different things. So you want to make sure that you know that difference. If a real estate agent or anybody else for that matter is giving you something in exchange for a referral, then that is a violation of RESPA, and the consequences can be quite severe. And you're going to see that here in just a moment. All right, so fee splitting or receiving unearned fees. If I've got an assistant and I'm making a fee and I'm going to split that fee with somebody else because I'm on vacation and they're going to do the lion's share of the work, well, they get paid their salary. I cannot split my fee with them simply because they did the lion's share of the work because I was on vacation. So no fee splitting. And we cannot require a customer to use services that are allowed to be shopped for because we get a special deal. Okay, so you cannot require that your customer use your mother who works at the title company. Not allowed. You can allow for specific legitimate discounts in the event that they fit into this category. A combination of services results in a lower price. It is given as an option to the borrower, and a lower price cannot be countered elsewhere. So if I tell my customer, hey, Mr. Borrower, if you use this title company and this escrow company and me as your loan officer, then we're going to get you this bundled price and it's going to cost you X. Okay? But if you do all of these items separately, it's going to cost you Y, which is a little bit higher. So if the customer chooses to utilize that package deal, then they can, but you cannot make it a requirement. It has to be given as an option. All right, section 9 of RESPA. This section is all about title insurance. You as the loan officer cannot require that a specific title insurance company be used. The borrower has the right to choose that on their own. Now, every state is a little bit different. Excuse me, and sometimes states say that the seller of a product gets, or the seller of a house gets to choose title, and other states say the buyer gets to choose. If the state allows the buyer to choose, then even the real estate agent or the sellers cannot make you use their title company. If you're paying for it and you get to choose it, then that is your choice. If the seller says, use our title company, we'll pay for it, use your title company and you pay for it, then it's your choice. You can allow the seller to choose it and they pay for it. All right? Now, how are you going to remember section 9? Are there any golfers out there? Well, here's what I do to remember this. 9 holes of golf, and who's a major golf apparel and equipment provider? Titleist, right? So section 9 of RESPA is all about title. Where's title? Or there we are. All about title. So section 9 is about title. And this is exactly what I was just explaining. Prohibits the seller from requiring a home buyer to use a specific title insurance company. This does allow for the buyer to sue whoever required it up to 3 times the charges that were charged the borrower for that transaction. Typically, and again, it varies state to state, the fees for title can be around 1% of the loan amount. So $100,000 loan, $1,000, somewhere in that ballpark. And if you just read that, or you just heard me say that, this means that if you require somebody to use a specific title insurance company, you would have to pay that customer $3,000 for making them do that, which was a prohibited act. So make sure you're not requiring your buyers or your borrowers to utilize the service you want. They get to choose that on their own. Now, section 10 of RESPA is all about escrow limitations. By escrows, we mean the amounts that you pay for taxes and insurance and having an escrow account, which again, the West Coast calls an impound account. The escrows are limited to 1/12 of the annual disbursement. That's a lot of information. What does that mean? Break it down for me, right? Well, let's just say, I'll do it on the board here. Let's say that your taxes, or let's say your taxes are $1,200 a year. So taxes a year. You don't pay your taxes all at once, right? If your taxes and your insurance are escrowed or impounded, it means that you pay 1/12 or 1 monthly payment, and then at the end of the year, the full amount's due, and the lender sends it off for you. Well, this would equal $100 per month, right? Because 12 months, you pay $1,200 over the year, $100 a month equals the $1,200. The lender cannot charge you more than the $100 that is needed. That's an escrow limitation. So whatever the monthly amount is, or the yearly amount divided by 12, that's the maximum the lender can charge. They can't charge you more for the, convenience of having an escrow account. All right, so that's an escrow limitation under section 10 of RESPA. Now, at closing, there is an allowance of 1/6, or basically 2 payments to be collected at closing, because oftentimes after a sale occurs, the cities will reassess the tax base. So if they do that, they want to make sure they've got a little pad or a little cushion to make sure that you're not going to be short later on. So at the closing, the lender or the escrow is allowed to accept 2 months of this at the closing table, and then the 1 month increments throughout the year. So in this example, we would be allowed at closing to have the 2 month cushion, which again in this example would be $200. Now, when it comes to RESPA Section 10, lenders are required to annually analyze the escrow account. Have you paid too much? If they have, then they have to give a refund for anything more than $50, and they have to let the borrower know if there's any shortage, and if you don't bring it current or send in more, then we are going to have a problem when it comes time to pay taxes or insurance. This does not require, or this law does not make it so that lenders have to have an escrow account. They just say if you have an escrow account, you absolutely have to follow these rules. So those are your 3 main parts of RESPA, Section 8, 9, and 10, but there's also big disclosure requirements under RESPA. Again, RESPA disclosures apply to these types of loans. If it doesn't fit into these types of loans, then it's going to go under the TRID, or the combined disclosures of truth in lending and RESPA. So first, let's go into your RESPA disclosures that would apply to these transactions. Within 3 days of the loan application, remember loan application is pencil. When you've received pencil, then you have to give out your disclosures. Well, these disclosures would be required within 3 days of taking the loan application, just like you had to do under TILA. The disclosures here is a special information booklet, the good faith estimate of costs, and the mortgage servicing disclosure statement. Those are the disclosures required within 3 business days of receiving pencil, or in theory, the loan application. Now, after the first 3 days, but before the closing of the loan, then you have these 2 additional disclosures, the affiliated business arrangement disclosure and the HUD-1 settlement statement. But the HUD-1 settlement statement is only used in the event the borrower asks for it in advance of the closing. They're going to get it at closing anyway, but if they ask for it in advance, they are entitled to it at least 1 day beforehand. So the affiliated business arrangement disclosure is required anytime you have 1% ownership in a business that is a party to the transaction. So let's say again, I own a mortgage broker shop, or I'm a mortgage banker, either way. And I also own an escrow company. If that escrow company is being used on this transaction, I have to disclose to the borrower that I have at least 1% ownership in both businesses, because I'm going to profit on both pieces. The borrower has a right to know that. All right, at settlement. By settlement, we mean closing. So at the closing, you have to give the HUD-1 settlement statement, even if you already gave it 1 day before. You still have to give it again at the closing. And the initial escrow statement. That's the statement that says, this is what we're collecting for taxes, this is what we're collecting for insurance, this is what we're going to send out for taxes and insurance throughout the year. And then after settlement, which rarely will you ever have to do, typically this is going to be handled by your lending servicing departments. They're going to give the annual escrow statement, which again, this is how much we've collected for taxes and insurance, this is how much we've sent out for taxes and insurance, and a servicing transfer statement. This is probably one of the biggest pet peeves of consumers in the mortgage industry. They go to Bank of America to get a loan, and then Bank of America sells their loan off to someone else to service it. And they're a nightmare to deal with. It's not what you wanted. I wanted B of A, and now I end up with someone else. That's not what I wanted. Well, and it happens over and over and over again in typical transactions. So most people don't like that their loan or their servicing is getting sold from one company to the next, and now I have to make my payment somewhere new. But regardless, lenders are allowed to do that. But if a servicer does sell off the loan to another service provider, they have to give the servicing transfer statement. All right, now, again, this applies to these items that we just mentioned here, and then there's new disclosures that are going to be given in the event you have some other type of a transaction. Now, we already talked earlier about what an application is. The same rule applies under RESPA. It is pencil. Property address, estimated value, name, credit, or social security number to obtain the credit report, income, and the loan amount. If you're missing one of those items, then you don't have technically an application and you're not required to send out the mandatory disclosures. So let's dive into the good faith estimate. This gives you an amount or a range of the charges that you should expect on an estimated basis to be charged in order to get this loan. They are required within 3 business days of receiving pencil, and this requires settlement charges to be available for 10 days. Huh? What does that mean? Most people don't get that. What it means is if you come to me and say, hey, Shar, I want a loan, and I say, okay, great, this is what your costs are going to be. People are always going to ask, well, how long are these costs good for? Well, the fees themselves, I have to make sure are available to you for at least 10 days. That gives you some time to shop around and see if you want to go with me. Now, I can't promise the rate's going to be still available because that's going up and down and all around all day, every day. So these are the fees that once I disclose them to you, I have to adhere and honor those fees, okay? But after 10 days, those fees could change because things do change in the marketplace. What used to happen back in the day was people would tell you that these are your fees and they're only good today. You've got to sign and go with me today or this deal is off the table. Well, that's a high pressure tactic, and CFPB and the government feel that that's not a good way to get somebody to do a loan, especially because it is a big commitment that is, detailing and having to deal with the customer's funds and their money and their livelihood. So they need time to consider that information, and that's why the 10 days is a requirement. All right, and then again, it does allow for some average charges, and that's because sometimes you don't know at closing what the finite end gain fees are going to be. So it gives you a little bit of room for average charges in the event you're not able to determine them at the time of disclosure. Now, the good faith estimate, it's a very detailed form, okay? You have to give it for free to the customer. It's a mandatory disclosure. You can't charge the borrower to give it to them. You have to provide it as a free service. This explains the dollar amount of the settlement charges. Remember the truth in lending statement? It was a lot of your overall averages and your numbers, so the annual percentage rate, which is spread out over the life of the loan. These are your dollar amounts, so they're not all your fees lumped in together. They're your fees that are broken down into individual types of categories. Right? Again, required within 3 business days of receiving pencil, and they can be provided by you, the loan officer, your broker company, or the mortgage lender themselves that is actually going to be doing the loan. They're going to be giving the money. All right, so it is required under RESPA. You use their approved standardized form. Again, there's the TRID disclosures and there's the RESPA and TILA disclosures. They're all federally mandated, and you have to use their forms. You can't create one of your own. So page 1 of the good faith estimate gives all this detail, fairly self-explanatory. Explains the purpose, summarizes the important data, gives you the important dates, the summary, the escrow account information, and the summary of settlement services. Most people work better with pictures, so let's show you what this actually looks like. This is the top part of a good faith estimate. It says the purpose here, shopping for your loan, and also gives you the important dates. The rates available through today, because that's all I can promise you the rate's going to be good for. It also says the rest of my settlement charges are available for 10 days later. And then after you lock your rate, it's going to be good for this period of time. What that means is if you've locked your rate for 15 days, you darn well better close that loan in 15 days. So this is going to be 15, 30, 45, 60, however long you and your loan officer have decided to lock the loan for. You must lock the interest rate for a certain number of days in order to wrap up and close the loan. All right, continuing on, document settlement charges is what's on page 2. It indicates the acceptable amount of tolerances or the level of change that's allowed to be made in those sections. And there are certain categories that you are allowed to shop for as the consumer or the borrower. If you want, well, all lenders are required, or all MLOs are required to provide the borrower with at least a starting list of other providers in the categories that they can shop for. You can't just send them out to their own devices. So on a separate sheet of paper, at the same time you give the good faith disclosure, you are required to give at least one person in each of the categories. It would be like the title company, an escrow company. If there was a requirement to have a pest inspection, the pest inspection company. You have to give the borrower at least one service provider in each category. And this is what the summary of page 2 looks like. Basically all the details, your loan amount, the term, the rate, Can your interest rate change? All your escrow account information, and then the summary of this information. Now, page 3 is where it really gets interesting. This is still on page 2. Now, our origination charge. These are all the fees charged by the lender and the broker lumped together and added right here into this box. Box 2 is the credit or charge for the specific interest rate chosen. This is where it gets a tiny bit tricky, so stay with me. When it comes to interest rates, you can either just get what the rate is, and this is what we charge, and we call that par. It just is what it is. You're not paying more and you're not getting less, or you're not paying more and getting a credit to get this rate. You pay this rate, you pay us these fees, done. We call that par. The next one is you receive a credit. Okay, that means you're going to have a slightly higher interest rate, but the lender is going to help you pay for those costs because you're paying them a higher rate. And then the last option is you can pay a charge, which means you're going to pay more now at closing to obtain a lower interest rate for the course of your loan so that you have lower payments and ultimately less interest over the period of the course of your loan. Now, real quick, let's move back over to the board and let me show you an example of this. All right, let's say our loan amount is $100,000. Loan amount. All right, now let's say our interest rate is 4%. Okay, let's call this our par rate, okay? My fees, the companies that I work for, and my fees to do this loan for you, let's just call it $5,000. All right, that's all me and my company's fees. Underwriting, processing, all those types of fees that are in-house at my office or at my company. All right, that again is called par, or pretty much zero. Okay, you get 4%, you pay us these fees, you're done. There are other fees, but not at my company. All right, now, something else that you could choose to do is get a 3.75% interest rate. And I'm making these numbers up, I'm just going with the flow. So these numbers are gonna change all day, every day. So this would be called cost, okay? Or a buy down. All right, I'm gonna pay more at closing. So let's say the cost to do this is 1 additional point. Well, if my loan amount is $100,000, 1 point is equivalent to 1% of the loan amount. So it's going to be an additional $1,000. So instead of $5,000, this is going to cost me a total of $6,000, okay? So it's not 5 plus 6, it's a total of 6. It was the 5 plus the 1. So in order to get a 3.75% interest rate, you're going to pay $6,000 to me and my company in order to get you that rate on this loan. Now, another option that you could choose is to go something slightly above par. So let's say we're going to go with 4.25%, and this is going to be called a credit or a yield spread. Credit, which is also known as a YSP, which is a yield spread premium. Now, if I do this 4.25%, let's say in the same example, it's 1% of the loan amount. So $100,000 times 1% is $1,000. So basically this means the lender is going to credit your costs, these guys up here, by $1,000. So you pay 4.25%, but you only pay out of pocket $4,000 to me because the lender is going to get more money over time, slightly higher payment because a 4.25 is higher than a 4. So you get to keep more of your cash in your pocket at the close of the loan. You'll have slightly higher payments over the entire term of your loan, but this allows you to come in with less cash out of pocket and still be able to get the loan. Now, people always ask, which one do you recommend? Which one should I do? Which one's better? Every person is a little bit different. If I want to keep more of my cash in my hands and pay out to the lender a little bit more, then I'm probably going to go with the yield, with the credit, because I want to make sure that my money stays in my hands for as much and as long as possible. Other people may say, no, I want to pay the lender as little interest as I possibly can. It's already too much, no matter how much it is. I want to pay them as little as possible. So that's when I'm going to go with the 4.75. I'm sorry, the 3.75. I'm going to pay more now. A little bit extra cash is going to pay out a lot less in interest over time. So if the par rate is the par rate and you can afford this $5,000 out of pocket, then fine, go with this. It's all a matter of what's important to you. If cash is king to you and you want to hold on to as much of your cash as possible and you want to let go of it one little month at a time, then go with the credit version. If you want to pay a little bit more now to save money later, go with the credit. And if you don't want either one of those, you just can go with it is what it is, this is what the costs are, this is what I get, and move on. There's no right or wrong answer. It's really about which version and which option fits your borrower's needs the best. Okay, so that's section 1 of the good faith estimate, right, on that chart piece. Now, certain fees can change and certain ones cannot. We're going to get into that in just a second. Just so you know, though, these 3 are unchangeable boxes unless you have what's called a changed circumstance. This has what's called a zero tolerance. Now the next piece is this. These ones have 10% tolerance. So if anything that you have in box number 3 changes by 10%, you're fine. You don't have to redisclose. But if it changes by more than 10%, then you do. So if I had here $3,000, and it can be a multitude of services. So this is required services that we select. We is the lender. So this could be appraisal, credit report, flood certification, mortgage insurance. Those things fit here in this category. Let's say the total in this category is $3,000. If anything in this section changes up to $300, I'm still within tolerance, okay? Because I went from $3,000 to $3,300. That's okay. No need to disclose because it's within the 10% tolerance level. If it's more than that, if it's $3,301, now you have to redisclose. All right, so these are required services that we select, the ones that the lender selects. Box 4 is title services and lender's title insurance. This is again a 10% tolerance because the money's not being paid to you, the lender. The money's being paid to the title company. So with that, I can't be in control of whether or not the title company changes their fees. So that's why you're allowed that tolerance level. Not a big deal if they change, you just have to redisclose. Owner's title insurance. So this is an optional coverage. You don't have to have it. Different parts of the country say that sellers pay for the title insurance. Owners pay for it in other states. So just again, call a title company and ask them, who pays for owner's title insurance, the seller or the buyer? All right, owner's title insurance is a 10% tolerance box. Basically means if it goes up by 10%, you're fine. If it goes up by more than 10%, then you have to redisclose. Next box is box 6. This is required services, but you can shop for them. That would be like a home inspection, a pest inspection, escrow services, a notary. All those go in there. And again, 10% tolerance. Box 7, government recording charges. Government recording charges is a 10% tolerance box. It's the fee that the state or the city that you're in requires in order to record that loan. That's also, again, 10% tolerance. Transfer taxes. Transfer taxes is zero tolerance. So contact your escrow companies and say, this is the city or the county that the house is in. What are going to be the transfer taxes? Zero tolerance. Now, again, that doesn't mean it cannot change no matter what. It just means if it does change by a single penny, you are required to redisclose. Now, this is zero tolerance. Most people mix up transfer taxes as zero and government recording as the 10%. Here's how I keep them straight. There are 2 things that are certain in life, right? What are they? Death and taxes. So if taxes are certain, they are a certainty, then they are what they are, right? So that's what we're saying here. Taxes are certain. So you give this certain amount. If you change it by a single penny, you have to redisclose. The government. Won't the government take more of their money, more of your money if they can? Of course they will. So if the government can take more of your money, then they're going to have a higher tolerance level in that category, right? So government is 10%, transfer taxes is 0. All right, now the rest of these items, the deposit for your escrow, daily interest charges, and homeowners insurance, no tolerance levels whatsoever. They could go up $1,000, $1 million, whatever, it doesn't matter. If those items change, you are not held responsible. You do not have to redisclose because of changes in those categories. All right, average charges. I mentioned this a little bit earlier. Average charges are things that if you don't know, why would you not know what the fees are going to be? Well, sometimes on something like a construction loan, the loan's not going to close for 18 months. I don't know if it's going to close or if the fees are going to be the same then than they are now. So those are where you're allowed to do average charges. Okay, so just again, things that are based on a period of time or a type of the loan or a geographic area. These are not allowed to be fees that are based on the loan amount. Loan amount is what it is. So if it's a fee that is based on the loan amount, you can disclose that because you know how to do that math. All right. Good faith estimate, page 3, summary of all the categories, shows you a trade-off table, which I'm going to give you an example of in just a second, and gives you a shopping cart. So these again are the areas that can change, cannot change, and are limited to 10%. This one here, these fees cannot change. These one here can only change by 10%. These here, no limits, they can change to your heart's desire. This is your trade-off table. Here is your par example, okay? So this is going to be 5, this is your loan amount. Your rate, our example was 4%. The initial monthly amount owed, which is your monthly payment, okay? This is your test category or your control group, okay? There's no change here. And this is what your total estimated closing costs will be. This one is the same loan, but your loan amount is this. Your rate in this example was a little bit higher because you're going with a credit, okay? This is the monthly payment. You're going to pay more every month by this amount. You're going to have less closing costs at the time now of closing. And this is what your total estimated overall closing costs will be. And then this one, same loan again, loan amount goes here. Your initial interest rate is something less, like the 3.75 that we talked about. This is how much lower your monthly payment's going to be. This is your monthly payment. This is how much lower the payment's going to be. This is how much more your closing costs will be. And this is the overall total amount of costs at closing. So it's the same loan, but how do you want to pay for it? Here's your rate, here's your fees, move on. Pay less at closing, but pay more every month, or pay less every month, but pay more at closing. It's your choice. And then this is the shopping cart. The shopping cart says if you're going to shop around for a loan, it gives you space for 4 different lenders to provide you with documentation. You compare them apples to apples on each comparison. So you write all the information down, the name, can the loan change, what's the rate lock period, giving you an apples to apples comparison of what you're doing compared to what 3 other loan officers are doing. Now you're not limited to 4, it's just that's all the space on the form. So these are just an easier, simpler way to help a customer shop for their loan and make sure they're getting the best deal for them. Now, availability of terms, I said this before, you have to provide these documents within 3 days of the initial application being taken or pencil. And you have to make sure those fees are available to the borrower without change for at least 10 days. Okay, you can extend it, you can make them available for 30 days if you want, but a minimum of 10 days by the government regulation. Unless the rate is locked, again, none of these items apply to the rate. Until the rate is locked, it's going to go up and down and all around, so it doesn't matter. Once it's locked, then you have to redisclose with what the amounts are at that time. Tolerances, we already went through this, so this is just a simplified way of reading it. If sometimes people are seers, and those are the ones that make sense, other people are readers, so we provided it to you both ways. And again, if you need to go back and rewind and watch this piece again, you can always pause it and read all of the details for each section that has the tolerance levels. Now, real quick last item, bullet point. Mortgage loan originators can cure a tolerance violation within 30 calendar days. So let's say we went to closing and one of our fees was off and it's going to throw us out of tolerance, which means we're going to have to redisclose. But the customer is already with the notary at the escrow company to sign all their docs. They had to take off work. They had to find a babysitter. Are they going to be happy that they have to leave, get new disclosures, and move on down the road later? No, they're not going to be happy about that. One thing you can do is talk to one of the companies or one of the, whoever it was that fee was out of tolerance on, and ask them to scale it back so it's within tolerance, or the lender can credit the borrower for that fee in order to bring it back down into tolerance. So this can help you, again, but the tolerance correction has to be done within 30 days of closing. So it just helps the borrower close on time and not delay the process. Again, it is binding. You are bound to the terms of this disclosure. What used to happen back in the day, which was a pretty unscrupulous common practice, unfortunately, was a loan officer would tell a borrower, we're going to charge you these fees and this is your rate and this is what the total cost of your loan is going to be, knowing full well that they were going to change those fees later on down the road. But they wanted to suck you in and wait until you had the moving truck sitting in front of your house and all of your ducks in a row, and they're not telling you in advance that your fees are going to go up because they want to make sure that they're going to make more money and you're kind of locked in and don't really have much of a choice. Well, that is now a violation of RESPA. Whatever you agreed to in the beginning has to be the same as what it is at close, unless there's something called a changed circumstance, which you'll see here in a moment. That changed circumstance is a justifiable reason why the fees changed, and the loan officer has to redisclose what the new information is within 3 days of learning of the change and give it to the borrower at least 3 days before the closing. So that way they have the ability to read it, review it, decide if it's still for them, and decide if they want to move forward. At least then it gives you time to call the moving company and cancel versus, okay, the truck's already full and in front of my house and now you're telling me my fees are double. So this prevents that from happening. So you are bound by what you tell the borrower in the beginning or what you disclose to the borrower in the beginning. It can change with redisclosure. All right, so this is what we were just talking about, 3 days of the changed circumstance. That leads to the next question. What the heck is a changed circumstance? Well, this is something out of your control that happened and changes the terms of your loan. We mentioned one a little bit earlier. What if the appraisal we thought was going to be at this and it came in a little bit lower? Changes everything about our loan. So that's a justifiable changed circumstance. Something shows up on title and you weren't expecting it and it's required to be paid off. The debts are higher than what they were expected to be, which changes your debt ratios, which means you have to change the terms of the loan. All of those are justifiable reasons to change the good faith estimate. You're allowed to do that. It just has to be for a justifiable reason. Now, reasons for changing. Again, something that changed or increased the fees, something that changed the eligibility for that program. Easy for me to say. Borrowers requested a change. I don't want the 30-year fixed anymore. I want the 5-year ARM instead. Justifiable reason. Or the rate was not locked and now the rate is different than what you thought it was going to be. Redisclose and you're fine. Okay? Now, if clearly disclosed, the mortgage loan originator can issue a new good faith estimate on a new home purchase and the settlement is expected more than 60 days from the good faith estimate. So again, you can give a new good faith estimate in the event you're working on a new home. Because so you were in contract for one, you're not in that contract anymore. So now you've gotten a new property, that's a reason. Also, closings get delayed all the time. Now you did the home inspection and the home inspection found some roof repairs that needed to be done. The seller needs time to do those roof repairs. So that's going to slow down the process and that changes things. That's a good explanation for having to change a good faith estimate. Change circumstances, again, things that we already mentioned. You found out that somebody is married still. They're not truly divorced, or maybe they were separated but not legally, and they said they were divorced. That changes things. Now we've got that whole issue of community property, and is somebody else, do we have to buy them out? Couldn't create a whole new open can of worms. All right, so acts of God. All right, if there's a hurricane in an area, that's probably going to change your loan terms a little bit. So if an act of God, war, disaster, or other emergency occur, this could change the fees that companies are doing loans at. So again, justifiable reason to change. All right. If information relied on in providing the good faith changes or proves to be inaccurate, people always say, huh, what does that mean? Let me give you a funny little example. Let's say you ask your borrower during the application, do you pay alimony, child support, or separate maintenance? Person says, no, I don't pay child support, alimony, or separate maintenance. Okay, great, and you mark the no box. Okay, but then you look on the title report afterwards, or also something called a prelim, and the guy has garnishments, or the guy has a lien for past due child support. And you go back and you say, hey, Mr. Jones, I asked you if you paid alimony, child support, or separate maintenance. And he says, yeah. And you say, well, you said no. And he says, yeah. And you say, but it shows on this, title report that you are due for past child support, dues. And he's like, I don't understand the problem. And you're like, well, I asked you if you paid it. And he's like, exactly, I don't pay it. So what's the problem? Right? Well, obviously that's going to change. And somebody took something quite literally. And obviously it should have been said, are you obligated to pay alimony, child support, or separate maintenance? Not whether or not you actually pay it. So that would be a very justifiable reason. Something that they told you turned out to be inaccurate, intentional or unintentional, doesn't matter. If it changes the terms of the loan, you can change the good faith estimate. You just have to redisclose. Or sometimes people don't think they're in a flood zone, or a flood zone plane has been changed, or the flood zone map has been changed. If that's the case, you're now in a flood zone, that's going to change your fees. All right. Does not include basic information relied on unless, again, it changes or is proven to be inaccurate later, or the loan officer did not rely on that information. All right, the customer is, has only been in their line of work for 10 years. He's really been in it for 12 years. Doesn't matter, that doesn't affect things. But just because you found out that information later on and want to change the good faith estimate had no bearing on the qualifying for the loan. So you can't change it for that situation. I always have this running joke that a lot of times customers up front seem like they're nice and warm and wonderful, and they turn out to be Jabba the Hutt or Matilda the Hun. Doesn't affect your loan, however. So sometimes back in the day, people would try and charge like a PITA fee, a pain in the, fee. And people would say, I worked 10 times harder on this deal than I ever thought I was going to. So I'm going to charge you 1 point extra for all my extra headaches and hassles. Try again for double jeopardy. Absolutely not allowed. That has no bearing on the loan or the qualifying. Even though you had to work harder than you thought you were going to, you cannot charge that to the borrower. All right. So again, you didn't rely on that information unless it fundamentally changes the loan. There's no change that you can make to the fees. All right. Market fluctuations themselves are not considered a changed circumstance. So if rates go up and your rate wasn't locked, that is what it is. Sorry, Mr. Borrower, we should have locked when I advised. All right. Or rates go down and you're already locked. A lot of borrowers say, well, what does this allow me? If the rates go down, can I relock? Generally, no. What you may have to do is pay a fee to unlock and relock at the new lower rate, which is going to cost you money, which may be a futile point. Or you may have to cancel that loan entirely and then start it all over again, which if you've got closing dates and a purchase and somebody else's sale and somebody else's purchase is counting on yours, that can really mess things up. So it's not highly recommended by any means. And again, good faith estimate, the fees that you gave, cancel in 10 days if the borrower does not tell you that they wish to proceed.